Welcome to Citrin Cooperman's Corner Chats. I'm Peter Katz of Westfair Communications, publisher of the Westchester County Business Journal, Fairfield County Business Journal, WAG Magazine, the website westfaironline.com, and electronic newsletters such as News at Noon to keep you fully informed. On this edition, we'll be chatting with Ron Hegt, a tax partner at Citrin Cooperman who has more than 4 decades of experience in accounting and taxation. Among the clients he serves are entrepreneurs, their businesses, and their families. He works extensively with partnerships, S corporations, estates, trusts, and ultra-high net worth individuals in tax compliance, as well as advising on business acquisitions, dispositions, and intergenerational transfers. Ron, welcome to Corner Chats.
Thank you, Peter. Pleasure to be here.
And Ron, let's begin with something that'll be easy for you. Give us a little bit of your background, your experience, what you bring to the table for the people who come to Citrin Cooperman for advice.
Absolutely, be happy to. I've been practicing in the tax area for, let's just call it, in excess of 40 years. I'm the co-leader of Citrin Cooperman's high net worth individual practice. And for those that don't know a lot about Citrin Cooperman, we are a top 25 CPA firm in the country with 1,300 people working for us and with us in 12 different offices. And what we strive to do and what we hold ourselves out to do is significantly more than just tax compliance. We're here to work with our clients every day of the year for planning and questions and business acquisition assistance, etc.
Now, Ron, when we were planning this corner chat, we were looking to title it Everything You Need to Know Before April 15th. But of course, that title has to change now, doesn't it?
Yes, it's now, what does everybody need to know before April 15th and May 17th? And the reason for that is on March 17th, the Internal Revenue Service extended the due date for individual tax returns to May 17th. They actually yesterday provided a little bit of clarity regarding what is extended and what has not been extended. The single largest area, and I guess I'm doing this in chronological order, is on April 15th, individuals are still going to be required to make their first estimated tax payment on their 2021 tax liability. Now, that in and of itself is going to create a problem because generally, an individual makes their quarterly estimated tax payments based on what they owed in the prior year. But this year's tax return, the 2020 tax return, is not due until May 17th. So the question becomes, how are we going to figure out what needs to be paid when we don't know what last year's taxes were? The answer is we're working closely to try to get to the right answer by getting people to focus on getting everything done as if April 15th with a due date. And the other issue is if you owe an estimated tax payment in April and you pay it in May with your extension at a 3% interest charge annually from the IRS, the world isn't going to come to an end if you're approximately 30 days late on your first payment. But as to what else is due May 17th, individual retirement account and HSAs, health savings accounts, can also be funded up to May 15th rather than April 15th.
Are people going to be confused by all of this? I mean, these changes really hit many people by surprise.
Yes. There will be some confusion. There has been some confusion in the professional arena as well as to what is being extended, what is not being extended. The IRS is clarifying that. It's been a year of confusion. The bottom line is if people focus on getting taxes done as if they're due April 15th, the easy thing to remember is if you owe money, you get an extra month to pay the money, but at least it gets the burden of preparing your return gets out of the way, is behind you, and the government will take their money a month later.
Is this another prime example of why you really need a professional to work with you, and that you're really almost committing financial suicide if you try to do a complex return yourself these days?
Absolutely, and I couldn't have said it any better. Tax laws have been getting more complicated year over year for probably the last 15 years, but certainly in the last 13 months in this unusual world that we are all living through, not having somebody that spends their entire working day focusing on what's changed literally this week could lead you to a position where you're not aware of something that, if you don't know about it, could cost you money. And if you're aware of something, it could save you money. And I could give you one specific example as we start to talk a little bit about the nitty-gritty of what people need to think about. About a month ago, in the American Rescue Plan Act, there was a change to individual taxes effective retroactive to January 1, 2020. Specifically, I'm referring to unemployment insurance taxation. If an individual in the year 2020 received unemployment compensation from their state government, the law now says if your income without the unemployment insurance is under $150,000 in 2020, for federal tax purposes, you are entitled to exclude the first $10,200 of unemployment compensation received by each individual. So that if a married couple each collected unemployment in 2020 and their income is under this $150,000 threshold, they can exclude $20,400 of their unemployment compensation from their federal tax return for 2020.
That could have a significant impact on someone's wallet, really, if you forget to do that or you use wrong numbers somehow.
Absolutely, it can. There are some cures for that, because clearly some people have filed their 2020 tax returns in advance of this law change. And the IRS has specifically said, if you're one of those people, please don't do anything. Their computers will be corrected so that if you overpaid because of unemployment insurance, you will automatically get a refund from the federal government.
And as an experienced accountant, I mean, you've interfaced with the IRS, for decades, obviously. What do you see happening in the agency these days? Have things become, so complex that even they are having trouble keeping up?
Depending on the level you're dealing with, a lot of things have gotten more cumbersome, more time involved, and at times more frustrating. Clearly, on the tax examination side, agents are working as hard to try to keep up with the tax law as we are. They have the advantage of, by the time they get something to examine, it's 2 years after we've worked our way through it, so they've had a chance to catch up. But on a real-time basis, the problem that not only these multiple law changes created, but the pandemic and the shutdown of the Internal Revenue Service, along with everything else in the country a year ago created, is at one point the IRS acknowledged that all their service centers had tractor trailers filled with unopened mail that had not been processed. They acknowledged before Congress several months ago that they were working their way through this pile of mail, but there was some 600,000 pieces of mail still unopened. And from a Citrin Cooperman perspective, I can tell you we've had a number of clients that have gotten notices from the IRS going back as far as September of 2020. They've responded. They've sent checks for whatever reason for balances that were due. And to this day, some of those checks remain uncashed, and the IRS computer keeps sending, let's call it love notes, asking, why haven't you paid?
So with all of this going on, how do you, as an accountant, keep up to date with everything?
Reading every single day. I start my morning after a good strong cup of coffee with one of the daily services that I get that tell me what went on in the tax world yesterday. And it's constant reading, constant research. And it's, from my personal perspective, it's, after all these years, a love for what I still continue to do that makes me want to understand everything, to do the best that I can at the end of the day for my clients.
If I'm a new client right off the street, what are some of the things you would ask of me? What would you look for? What would you suggest that I do to get my material in line so that it would make sense to you right off the bat? First thing that I would do would be to say, when we're going to get together the first time, let's take a look at the past 2 or 3 years of your individual tax returns. If you're an entrepreneur and have interest in businesses, let's take a look at those. And that does 2 things. That lets me understand what your financial life is like. And it also gives me the opportunity to see if there are any opportunities to suggest potential changes to prior year tax returns that could result in refunds. And again, not necessarily because things were erroneously prepared, but again, what's made us crazy this year? In the CARES Act, which was enacted last March, the Congress retroactively changed the depreciation lives on real property from 27 years to, potentially for certain improvements, to 15 years, and created an opportunity to change 2018 and 2019 returns to get refunds. People need to be on top of this to be able to figure out how to take advantage of things like this. Is that one thing that we've seen through the emergency legislation that was passed, and perhaps through some of the massaging that's going to be taking place in terms of the tax law, that things just do change and not everyone can be aware of what happens because the code is so complex? Absolutely so. It used to be that it was once a decade that there were major tax law changes. We have gotten comfortable with once a year. There have now been, in the last 12 and a half months, 3 significant bills that change the tax law, sometimes retroactively, sometimes for 2021 and going forward, but it requires the opportunity and the need for us to keep up. As another example of what comes along as simple in the media, but really can be complex and can be advantageous if you understand it, is how these stimulus checks worked. The 2 stimulus checks, if individuals were entitled to them and received them during 2020, those were advance payments of income tax credits for the year 2020. When your 2020 tax return was done or is being done, your accountant needs to compare what would the stimulus checks have been if the IRS had your 2020 tax return, and compare that to what you actually got. If what you would get under your 2020 tax return is greater
than the stimulus checks that you got, good news. You'll get more stimulus money from the 2020 stimulus payments. And better news, if your 2020 tax return shows that you got more than you should have, the law says you get to keep that, and that money is tax-free.
What I hear you saying is that what you read in the New York Times or the Washington Post or whatever you happen to read may not be something you can rely upon, that you really need someone who's capable of going through every line of these complex tax laws.
Absolutely correct. And we'll go on to some other things that complicate it. But for example, the CARES Act was 5,700 pages long. Not all tax changes, but there were things throughout there that had impact on what we do. So to talk about one or two other individual things, and again, it goes to complication. I earlier talked about the federal taxation of unemployment compensation for the year 2020. If it wasn't complicated enough, at the moment, New York State is not adopting that change. So if New York State doesn't make a change to its tax law in its budget reconciliation process, which is supposed to be completed by April 1, New Yorkers will need to pay tax to New York State on 100% of their unemployment compensation, not reduced by the federal deduction that's being retroactively allowed. Connecticut individuals are better off because Connecticut is going to follow the Internal Revenue Code change, and New Jerseyans that collected unemployment don't need to worry about the state tax consequences because New Jersey doesn't tax unemployment compensation.
Well, as we're recording this, we really don't know what's going to happen. By the time people are viewing this, weeks down the road, perhaps, we might have an idea, or those people who have good accounting advice might have an idea. But you did mention the state element here. And with all of the changes at the federal level, with all of the machinations going on, have people gotten, how can we put this delicately, hurt when it comes to local taxes and state taxes?
Yes, and some of them are being hurt in several ways, and some of them surprisingly. Certainly going back to the tax law that was changed at the end of 2017, that an individual only gets $10,000 deduction for their real estate and income taxes. This viewing audience certainly has felt the pain of limited amounts of state tax deduction. But in the pandemic world, what has become complicated beyond description that could come back to haunt people is the question of what state is your income taxable? Now, in the simplest, if you live, by example, in New York and work in New York, everything is taxable in New York. If you live in New York and you work in Connecticut, you pay tax to Connecticut, and you pay tax to Connecticut on your wages, and you pay tax to New York State on everything else. But the problem comes in when people have picked up and moved out of where they normally live and live in another state. Most states have a law that says if you live in that state for more than 183 days, there are circumstances where they reserve the right to tax you as if you are a resident of that state. So how many New Yorkers, including a number of our clients, have picked up, moved out of New York City and are living out in the Hamptons, so it's a New York City issue, or are living in Connecticut or Rhode Island, or I've got clients that are living in North Carolina in their vacation homes. Your home and where your heart is, which is your domicile, is still New York, so you're taxable in New York. Other states have not ruled one way or the other whether they're going to attempt to tax your income twice.
So you need the accounting advice to keep you from being really hurt. Nothing worse than double taxation for many people. But tell me, when it comes to the things that the federal government has been doing, some people have the impression that what they're getting is a lot of free money. For example, let's suppose you've gotten a PPP loan and it's forgiven. How do you handle that? Is that free money, or are you going to get stuck for taxes on that?
Great question, Peter. And that leads to a discussion of PPP and another example of what is becoming free money. And I know nobody is used to or comfortable with the concept of there is free money coming from the federal government. But if you were in a business and you got a PPP loan, the tax law, and it's the tax law as corrected later in 2020, says not only is the forgiveness of that loan not subject to taxation, but that the funds that were used to pay expenses with this tax-free money remain fully deductible. That gets to where this money was intended to be, is grants to help businesses keep their doors open and pay their employees. And that is the logic behind understanding why this thing was tax-free. And as another example, and I will just discuss it quickly and give a example of an issue that I dealt with a client, and it involves, it's free money and you got to keep on track of the current rules to determine how much of it is free money. What I'm referring to on the business side is a program known as the Employee Retention Credit that was put into the law in the CARES Act effective March 27th of 2020 that said if an employer keeps its doors open, pays its employees, and I'm not going to get into all the limitations that would apply. For that, you need a good accountant. But the effect of that law said in 2020, if you paid any of your eligible employees at least $10,000 in any one quarter, you were entitled to a 50% credit against your payroll taxes for the payments that you made to that employee. By way of example, if you had 90 employees in 2020 in your business and you qualified for this employee retention credit at $10,000 per person, for one quarter, you'd have $900,000 of eligible wages. And the federal government would send you a check for $450,000 as an incentive to help a business keep its doors open. And if that wasn't good enough, the American Rescue Plan Act made a retroactive change for 2021 to make that more generous. And I was having this conversation with a client because the rules for 2021 don't limit you to $10,000 per quarter. It's $10,000 per quarter for all 4 quarters. And the percentage is up to 70% of wages. So that same employer that thought they got their $450,000 and were finished in 2021 with the same 90 employees that each make at least $10,000 a quarter, that's now a $630,000 credit per quarter. And if they qualify all 4 quarters of 2021, it's a $2.5 million tax credit that can be refunded in advance from the IRS to help employers whose revenue is dropping to keep their doors open and employees compensated.
That sounds like a dramatic event to take place in the life of any business, to get a check like that or a direct deposit like that from the federal government. How have your clients reacted when you tell them things like this, that this help may really be available to them if they do the right things?
The first reaction with this specific client, and given the magnitude of the numbers, was, "You're sure?"
Did he really say sure, though?
No, but I learned to clean things up with a microphone in front of me. But it comes down to the understanding of the intent of all of this. The government is better off when businesses have their doors open, people are being paid, the economy keeps growing, and people aren't collecting welfare or unemployment. It's just better long term for the government and the economy. And these are the things that everybody needs to get their arms around, because things continue to change by the moment.
And
now,
speaking of which, we're starting to hear now that the Biden administration is starting to float various tax proposals. Any scuttlebutt that you hear that might give a clue as to where this is going to go?
Yes, there are, and here's where Ron becomes the bearer of not such wonderful news. The proposals, and these are early proposals, they haven't made their way to Congress yet, so we haven't seen how the sausage will get made and what will come out of the bill. But what we are hearing is the proposals will be effective for 2022. But what we're hearing, and we heard some details this morning, is that the Biden administration is looking to raise the corporate tax rate from 21% to 28%. On individuals, they're looking to raise the top tax rate from 37% to almost 40%. But on top of that, and I'll use the word minor in quotes, 3-point increase, the plan would be to tax capital gains that currently are taxed at a maximum of 20%, at a maximum of 40% if an individual or a married couple has more than $400,000 of income. And for entrepreneurs that have interests in flow-through businesses, there is a flow-through business deduction that has been in the law since 2018 that allows qualified businesses, which are basically anything other than professional service businesses, to be able to deduct from their income 20% of their business income, which would reduce, under current law, their individual income tax to 29.6% on their business income. That also, under the Biden proposal, would go away, and that income would be taxed at 40%.
Is there any sage advice you have for people as these things start to become clearer on the horizon?
I would say for the instant, not to have any knee-jerk reactions, to begin to see what is happening. But we may be in a position where 2021 may be one of the lowest tax rate years that we see in a while, and people should be thinking about, do they have things in their portfolio that they've been itching to sell because maybe the time is right? This may be the time that is right, because you may be able to get in at a 20% capital gains rate, or as we get closer to the end of the year, if rates are going to go up next year, start modeling your business planning to increase your income this year, not decrease it. I know that's counterintuitive to what every accountant has always taught people, but this is may very well be a counterintuitive year.
And in terms of your career, your observations, your experience in seeing all of these changes over the years, and seeing where we are now, and getting some suspicion as to where things might be headed, how do you characterize the current tax situation for business people and for families too?
First word that comes to mind is frightening. And frightening not only because of the economics of what it could create, but frightening because nobody likes to live in times of uncertainty. Uncertainty creates stress. Uncertainty creates the need to have to rethink things that we have accepted as given for years or for decades. And it also is not great from a business perspective, where businesses try not to worry about the day-to-day, but worry about the year or 5 or 10-year plan. How much do I want to invest in plant and equipment? How much do I want to invest in more space or invest in new employees because I think that the economy is ready for a boost? Now, if I need to rethink those things because of potential large tax increases, it creates uncertainty, which certainly doesn't bode well for the economy as a whole.
And Ron Hecht, on that sobering note, thank you so much for a fascinating edition of Citrin Cooperman's Corner Chats. I'm Peter Katz from West Fair Communications. See you next time.